before you get started, let everyone see how you're getting to it. All right. I stopped the share. All right. So again, I'll read it again. Mike asks, could I missed it. Where is that?
So there's a question on Akamai looking
Yeah,
at
it's
the
Mike wants to look and analyze the AKAM, which is Akamai put spread, the 101.95 expiration November 22nd.
so November 22nd. And did he say from which side? Does he want to look at it from a debit or credit?
Mike, let us know if you want to look at it as debit or a credit.
So uh, it's looking at the 101.95 put spread, right?
Yeah.
In there. Okay. I'll give it like a minute just to see if he wants to look at it from
One side or another, Mike, just let us know.
yeah,
Do you want to buy it or sell it?
right. I'll look at it from a credit
All
price.
right, cool.
So we're looking at the
He did
question.
say credit.
Okay, so credit.
Perfect.
So let's look at this Akamai 101.95 put spread. It's a November 22nd expiration. So you could see here, I'm going to close this menu to expand the screen. So we're on the options chain. And just quickly looking at it relative to the other expirations, there aren't that many options trades in general going on in Akamai, right? So that just kind of gives you a sense of, because you could see here are the different expirations, the volume, 99 in the front month, 55 contracts in next month, the November 22nd expiration, only 2 contracts. And when there aren't a lot of trades going on, it gives you a sense of, what the liquidity of these options may be, or even the price discovery. The more trading that's going on, the more trades, not even necessarily, not just volume alone, but just the more trades that are going on, you have a better sense of where things could be trading. There's and the liquidity of the options, the opportunity to get executions at potentially better prices. There aren't that many trades here. The other thing before we analyze that put spread is November 22nd. We we could see that on November 8th, we have this little indicator in E. And the E is indicating that we're detecting either that there's an announced upcoming earnings, or we're estimating if it's not announced. But here we see November 7th that Akamai is expected to report earnings. So over here, November 7th after the market. So the November 22nd expiration will cover that earnings. If you're holding it, all the way to expiration or after November 7th, these options will cover the earnings announcement. So something to keep in mind. So let's set this up November 1st. It was the 101, right? So November 101 put. We're going to click on the bid because we're looking at it from a credit put spread standpoint. So we're selling the higher strike, and then we're going to click on the offer, buying over here, the lower strike, 230. So let's just slide down here and just make sure we selected the right legs. Selling the November 22nd put, the 101 put, 370. This populates the price, that we clicked on, the 370. You could change it, going up or down, type it in, but I'm going to leave it for now at that price where, we last took a snapshot. Then buying the November 22nd put, the 95 put for $2.30. And that is the price of the offer. So it populated the price that we clicked on. You could change this as well. We're going to leave it as is. in the beginning to analyze just the market prices, right? So that's what we're doing. We're just analyzing, well, this is where, where you could get an immediate execution here or better, but these are the displayed firm quotes. So let's analyze it from that perspective. I'm going to run the analysis. And now we get a bunch of statistics here, okay, that we could go through. And the first one, it says, okay, if you do it at these prices, right, 370 and 230, that will generate a credit of $1.40. Right? So that's doing it right on the market. Well, how does that price compare to like a theoretical benchmark? Like where, when we look at prices, right, we try to create benchmarks to give us a sense of like, well, how far away is it like from a theoretical benchmark or a benchmark that we could say where is a reasonable expectation based on history, where this is. Like if you're trying to, think of it as you're trying to buy a condominium, right, in Florida. Well, you'd want to compare it to, well, I have this price here. How do I know it's reasonable? Well, you could compare it to the last sales of the most recent similar condos, or you could compare it to, condos that are similar in different buildings, or you could compare it to other condos that are for sale now and see what those prices are. So you're looking at these benchmarks to see how far away are you, from from something that you're trying to give this particular security or strategy of value. So over here, this is using a certain benchmark, and there's different ones, this doesn't have to be the only one, but it gets you a starting point. And this looks at historically, based on how the stock moved, right? Just the stock behavior that covers the same amount of days, because over here, we see there are 28 trading days, we have 38 calendar days, but 28 days available for trading. Well, that's a long time. Stock moves can move differently in 28 days than in 1 second, right? Or 1 minute, or even 1 day. So you got a whole 28 days of trading going on. And we also have an earnings in between over here. So we need to find historically how that stock behaved given these circumstances, given like similar situation, right? So we're not going to analyze, how Akamai moves in 5 minutes, right? Because that won't apply here. We need to kind of try to analyze it by creating similar conditions. So that's what this is doing. It's going back in history and saying, try to recreate similar conditions using historical data, then go back in time and say, based on that behavior, how it moved, in theory, what is the average? What would the average value of this put spread be? Right? Sometimes it would finish out of the money, sometimes and it'll be worth zero. Sometimes it could be completely in the money and worth, in this case, I think it's $6, right? This difference, sometimes somewhere in between. So looking back in history, saying on average, right? You have zeros, you have $6, you have somewhere in between, but on average, what would this spread be worth? And this is saying $2.29. Okay. Doesn't mean it's going to be worth again we're just looking at a benchmark, an average here. So how far away are we from this average? Right? If we're selling it, how far away? If you're selling it, certainly you want to sell it at the highest price. right? When you're selling something, you want to get the highest price possible. When you're buying something, you want to get the lowest price possible, right? That's just because the risk reward, right? If you're buying something, you want to get the lowest price possible, because that reduces your risk and increases your potential reward if it goes up. And the same way is like if you're selling. So now we look at this benchmark, $2.29. We're like, well, how far away are we? Are we selling above it? Are we selling below it? And what's going on here? So, well, for receiving a $1.40 credit, certainly that's below this benchmark, $2.29. Right. So if historically, the average price is $2.29, we are selling it below. Maybe it's justified. I don't know. We'd have to go and, figure that out. Why are we selling below? Maybe something is different now. Maybe, now, there something changed with the stock that it's maybe volatility is lower, whatever it is. But, we do have a certain benchmark now that we could look at and see, is it justified? Because we're about 89 cents, right? 89 cents below this the theoretical value. So we do have this, we have this benchmark, we have this average, but the average could get skewed higher, right? Maybe $1.40 is fair. Maybe there was like, one or two really bad outliers out there that skewed the average high, right? So we want to know if we looked at the historical values, right? If we looked at all of them, some of them are zero, some of them might be $6, some of them might be $1. If we looked at all of them, right? How often did the spread based on the historical stock behavior would be worth less than $1.40, right? That's what we want to know, because how often did it go above? Because if 99% of the time it was, below $1.40, and then you had this outlier that pushed it up to $2.29, maybe $1.40 isn't so bad, right? Given that most of the time it's always below. So that's what we want to know, the win rate. How often historically would it result in a profit if we did it at similar, this value? That's what this is. It's saying 56% of the time. So what this is saying is 56% of the time, the stock itself, after that 20-day period with an earnings in between, that it ended up, the percentage move of the stock, from start to finish, ended up that this spread would have resulted in a profit if you received a $1.40 credit, right? So it's converting those percentage moves to right now. So that's what this is saying at this point. And, we could go in there and then change the parameters if we wanted to go look at these theoretical values. But I'm just going to leave it at that for now, so we could continue. The next analytic, it tells us, well, what's this liquidity of this option? Saying, okay, well, we know $1.40, right? But it's a very wide spread between $1.40 and $2.35. And when you look at that market, well, it's possible that you maybe get a better price than $1.40. Right? It's possible that you could sell it at $1.50 or $1.60. The higher you sell it, the better, right? So you got this big range between the bid and the offer, and maybe it could get executed somewhere in between, right? Let's say, the midpoint is $1.88, right? So that's the midpoint of it. Maybe you could even higher. Maybe somebody is willing to pay $2 if you show them that offer. So we could even change these prices and see if, like, well, this is now theoretically 229. It falls in between here, $1.40 and 235. It does fall in between, right? So if we got 230, you put in an offer of 230. I don't know, maybe somebody will say, well, that's enough for me. But certainly the theoretical value falls in between that bid-ask spread. And of course, it's kind of, if we use this theoretical value, 229, then the market looks like it's skewed, to the sell side, right, of that benchmark, right? The bids below, well below that, and the offer is 5 cents above, 6 cents above that. And if you wanted to change the prices and rerun these, you could change these prices and look at it from $2. Here, let's say we sold this. What if we got a better price? What if we, instead of buying it at 230, we bought it at, let's say $2, right? Let's say I'm going to switch that now to 2. And let's say instead of selling it at 370, right? Instead of selling this, 101 at 370, we got it at better. Look, you could sell it at 380 potentially, 390, $4. Let's say $4. Right? Okay. Rerun the analysis. Well, that will give us, $2 credit. So that's 29 cents. Edge, getting up to edge. So that's, so you could rerun it and recalculate this. So then just moving along to these summary stats. What about your risk sensitivities? So this is, when we're looking at options have different risks and risk sensitivities. So you have directional risk, delta risk potentially. You have a gamma risk. How much will your deltas change as the stock is moving, from one point to another? You have vega risk, which is how much risk do you have to the implied volatility move. You have theta risk, which is how much decay will these options, decay from in one day. You have rho risk. How much risk is there to the options if the interest rate changes? Because you have a cost of carry there. So these are your risk sensitivities. And they're low because I only put in one contract, right? But what this is saying is, well, you have a positive delta. If you're selling a credit spread, selling a higher put, buying a lower put, it's a more bullish outlook, right? You want the stock to go up because you want both puts to expire worthless. So the stock has to be above those strikes. So you have a positive delta here. You want the stock to go up. If it goes down, then this is your risk delta. And then you have a negative gamma here. So negative gamma means that, as the stock moves, right, you're accumulating, you have to hedge your deltas in the same direction as it's moving. So if the stock is moving higher, you're going to have shorter deltas. You're going to have to buy more deltas. If the stock is moving lower, you're going to get longer deltas. You have to sell deltas. So what it's saying is that, you're hedging in the same direction as the stock is moving, which a negative gamma could create a situation where the stock, if it's volatile, moving back and forth, you're going to negative scalp. So the stock is going to end up being negative scalp, because if you're buying deltas, you're buying stock as it's moving higher. And then if it moves lower, you have to sell it back out, while you're negative scalping. But you also have a theta. So you might lose on the stock, but the theta, if the options decay, may make up for that negative scalp. So that's your theta over here. And the vega in between, this is telling you how much risk you have to a one implied volatility move in the options. So if implied volatility moves exactly down one or up one, that's the risk you have in terms of vega. And then this is your rho, which is in a move in interest rates by 1%. Right. So if interest rates go like from 3 to 4%, or 3 to 2%. Okay, so then now you have your risk sensitivities to this strategy. Let's move over here, and we have this price chart. So the price chart kind of gives us a visual, and then we have a table actually below with the numbers, but it gives us a visual of how the price of the option moved throughout the day. So that's in this yellow line. And what this yellow line does is it tracks what the value of the option is changing by according to the mark-to-markets. And when we look at options, options, the value of the options can change even though it doesn't have any trading activity. Okay, so even though the option itself doesn't have a trading activity, as time goes on, the value of that option can change for various reasons. If the stock is moving, the value of the options could go up or down, even if nobody's trading. Because if you have a call price will be worth more if the stock is higher, and it'll be worth less if the stock is low. Because it's a derivative. It's following. It's being tracked. It's being priced off something else, right? The value of that option is being priced off something else out there. So to track it, what we're looking at is the bids and the offers, how they're changing. People are willing to pay more or less as the stock moves, or willing to sell it for less or more as the stock is moving. So because those are firm quotes, we could reference them. Of course, if you have a bid and offer and anything in between, what price is it? How do you track it? So this yellow line is looking at the midpoint. It's tracking the midpoint of the bid and the offer. We call that mark to market. Well, we have these other two lines here. And what are they for? Well, if we have a midpoint, it doesn't, you're tracking it, but it doesn't tell you the full story, because the midpoint, how reliable is it? If you have a market that's very tight, like if the difference between the bid and the offer is a penny, then the midpoint is pretty good at tracking it. But what if the market is $1 wide, or $2 or $3 wide? Well, I don't know if that midpoint is very reliable, or how reliable is it to track the value of that option. So we need a sense of how reliable it is, and that's what these other two lines are. One is tracking the bid price, and one is tracking the ask price. So now you see the spread. How wide is it? The spread, and also that spread, does it change over time? Does it narrow and widen out? Does it stay consistent? So that's what this graph is showing us. Where we do see the midpoint, and at the same time, we could see that the difference between the bid and the offers looks pretty wide. The difference looks, the distance is pretty significant here. And maybe at the beginning of the day it's wider, but it doesn't seem to close in that much throughout the day. Looks like it's pretty consistently, it's pretty wide. So it's not a lot of, you have to keep that in mind, not a lot of liquidity in this option. There's a lot of execution risk here. And here we see, in the table, the bid-ask spread was the highest, the widest it was $1.85 between the bid and offer. The lowest was 60 cents. The median is 75 cents, and the average is 81 cents. So you could see it started out the day at $1.85, the first snapshot, the very widest, and ended down 95 cents. So the widest, it looks like maybe in the morning, it's very wide, starts coming in, but not significantly. But if we just looked at the midpoint of the option, it moved around a little bit from the high to low, but at the end of the day, it ended up where it started. So there's no change. Okay, so that's quickly just looking at the price of the option. So I'm going to stop there. We're right up at 9:30.
That was great, D. Great analysis of Akamai's options play. Thanks for bringing that, Mike.
Yep.
I say options. Someone was asking about Jessica from Options Play, the spread in Akamai, not the options play. Sorry about that. The put spread.
Okay.
Awesome question, Mike. Thanks for doing that, D, for everyone. Everyone have a great Wednesday. Be safe out there.